All right, so let's get started. Now, the first thing I want to show you is the homework, right? And this is due Friday. This is due Friday. There were 3 problems. I know it says 9 questions here, right? But the questions are in parts, and that's how the computer sees them. This question we didn't do yet, right? This is the last topic in the chapter, which is really the first topic they show you, but I choose to do it last because it's different. We did this problem last time. This was a journal entry problem for transactions that affect inventory. And we did this problem, which is the income statement for companies that sell products, right? So the thing we're going to do today, we're going to dwell on, is this topic here. So let's take a look at the problem, right? And then we'll go through the book and what they want you to do. Now look what they present to you. They tell you this company, Sandra's Purse Boutique, had the following transactions related to one of its purses, right? Gucci purse, for the month of October, right? And they use the periodic inventory system. Now, in the past, we always, the past last week, right? The last couple of weeks, we learned how to do the perpetual inventory system. And the perpetual inventory system, you know, the word perpetual, what does it mean? It means constant updating. At any given point in time, we know how much is in the inventory account, and we know how much has been charged to cost of goods sold. We know that every time there's a transaction that involves inventory, you know, if it increases inventory, it's a debit. If it decreases inventory, it's a credit. And anytime we sell something, we had 2 entries to make, one to record the sale, debit either accounts receivable or cash, and credit sales revenue, debit cost of goods sold, credit inventory was the second entry, right, for what the cost of the merchandise was. So under that perpetual method, anytime something affected inventory or cost of goods sold, we debited or credited those accounts. Under the periodic system, we don't do that. Under the periodic system, we have to count the inventory once during the period or twice during the period, and then we make adjusting entries to change the number that's in the inventory account. We're not going to go that far with it, right? So we're not going to have to learn any journal entries for the periodic system. But to demonstrate this topic, the periodic system is much easier to see than that perpetual system. So I'm not trying to confuse you. I'm trying to do you a favor, believe it or not, right? So let's take a look at this problem. And then we'll go back to the text and we'll go through the illustration. But I want to show this to you first, so that when we go through the illustration, you can filter out all the noise, right? And just get to what we're going to have to learn how to do. So look at, they give you this diagram, this array with dates and transactions, and I see unit amounts, and I see unit cost amounts, and I see total cost amounts. Okay. Now notice, we start out with a beginning inventory, and then at various times we sell some of that inventory, and at various times we buy more of it, right? So you get an appreciation for what's going on there. These things don't happen all at once, right? They happen day by day. You don't buy all your inventory one day and then sell it all the next, right? You buy your inventory, you put it on the shelves, customers come in, some buy it, some just look at it and walk away. As the stock begins to diminish, you go out and buy more, right? So if you've worked in a retail store, you have an idea of what that is, right? How that works. But the unique problem that we have here, and we may have talked about it a little bit last time, the unique problem that we have here is what's the dollar amount for inventory and what's the dollar amount for cost of goods sold. And we'll see that there are 4 different methods for calculating that. 4 different methods. And some companies use the first method, and some use the second method, and some use the third method, right? And you may change jobs and go to another company that uses the 4th method. So you really have to learn how to do all 4 methods, even though only 2 of them are actually used a lot. The other 2 methods, we have to learn how to do them, but they're not used that often. So notice what they say here in the in the required. Calculate ending inventory and cost of goods sold at the end of the month using the specific identification method. So one of the methods we're going to learn is called specific identification. And what does that mean? It means we know exactly how much inventory is there, where it came from. Do we have any left from the beginning? Do we have any left from these various purchases that took place during the year? Because notice, every time we made a purchase of inventory, we made it for a different price, you see? On October 10th, we paid $890 per, these are purses, right? Handbags. You can substitute whatever product you want, right? But we paid $890 for each one of those handbags. And then on October 20th, we paid $900 for these 4. And then on October 30th, we paid $910 for these 8. So that's a second complication here. We paid different prices for each one. So how do we know which ones we have left? I can figure out how many I had. I can figure out how many I sold. I can figure out how many I had left. But how do I know where they came from? In other words, of the ones that I have left, are they these $910 ones? Are these $890 ones? Right? So we'll see how to do that. We're going to have to make an assumption about which ones are left. Now, with specific identification, you're not really making an assumption. You can identify which ones you have left. Right? You can identify which ones you have left. Here's a second method. Using Fifo. What does Fifo stand for? First in, first out. In other words, the oldest products are the first ones sold. What do I have left on my shelves? The newest products. The newest products. So calculate ending inventory and cost of goods sold using this method, the Fifo method. Right? And then there's another method, using the Lifo method. Lifo is the exact opposite. Lifo makes no sense because what Lifo says is, I sell the new products first, so I always have the old ones. Now, you know most businesses don't operate that way, right? Especially if you're selling a product that's perishable, right? You want to make sure that you sell the oldest ones first, because the longer you hold on to the old ones, something will go bad. Same thing with technology products. I want to make sure if I'm selling technology products like iPhones, for example, I want to sell the old ones first. I always want to have the newest ones on hand. Now, again, not to confuse the issue, but the problem here is we're making an assumption about which ones we have left. That doesn't mean that's what actually happens. Right? Remember, these are assumptions. And then the last method you'll see here is called an average cost method. Right, so let's Let's look at the textbook. Right, I like to do this because this way, when you leave me, you know what pages, what sections to concentrate on. Right. In other words, you don't want to read a whole accounting book from beginning to end. It's not it's not necessary. So just for background, right? Types of inventory. Items that a company intends to sell to customers. It's the stuff that's on the shelves. It's the stuff that's in the warehouse. Inventory is a current asset. Cost of goods sold is an expense, right? But you kind of knew that already anyway. Manufacturing companies, I'm just going to mention briefly. What's the difference between a manufacturing company and a merchandising company? A merchandising company is where we're going to focus, right? Best Buy is a merchandising company. They don't make the stuff that they have in their store. They buy it from the company that made it. So they'll sell Apple phones, they'll sell Samsung, they'll sell Sony TVs, right? They'll all the stuff they have there, they didn't make, they bought it from somebody else. Manufacturing companies make the product. And manufacturing companies, you'll study much more in Accounting 102 next semester. Hopefully you take it. You'll see that there are three types of inventory. There's an inventory of the finished products that we're ready to ship to the customer. We have inventory of the parts that we need to make the product. We call that raw materials. And then we have some products that we didn't finish yet. We may have started them during this period, but we didn't finish them. That's called work in process inventory, right? So I don't want to spend a lot of time on that. I just want to point it out to you that there's a difference between manufacturing and merchandising. We are going to focus on merchandising, right? And all of this has to do with manufacturing, so we can just blow past it. We saw this last time. I showed this to you last time. Cost of goods sold. Under the periodic system, we calculate cost of goods sold. See, under the perpetual system, we debit the cost of goods sold account. Under this periodic system, we don't have a cost of goods sold account. We have to calculate the number. How do you calculate that number? You take the beginning amount of inventory, you add any purchases of inventory that, that increase the inventory. That gives you something called the total available for sale. And if you subtract the ending inventory, that gives you the cost of goods sold. So if we walk through the numbers, beginning inventory was 20,000. We purchased additional inventory for 90. 20 plus 90 is 110. And if we still have 30, 110 minus 30 is 80. 80 is what we sold, right? And just think about that for a minute, right? I mean, you see all these numbers and sometimes you get confused, but think about the logic. Beginning plus purchases equals total available. Total available minus ending inventory is cost of goods sold, right? So if we know two of these three numbers, we can figure the other one out, right? And we're going to see that in some of the problems that we do. For us, the challenge is to come up with this number, this ending inventory number. Once we know what the ending inventory number is, cost of goods sold is very easy to figure out. But this is the number that we have to concentrate on calculating. And again, depending on what method we use, we can get a different number. right? We have 4 different methods. We could come out with 4 different numbers. Now, again, not to confuse things, companies pick one method and that's what they use. So it's not like 1 month they're using one method and the next month they switch to another method and a year later they switch to another. No, it doesn't work that way. Once a company picks a method, it pretty much sticks with it. If you take intermediate accounting, you'll see that it's really complicated when a company changes method, the things that they have to do. So most companies, once they pick a method, they will stay with it. Right, and here is the income statement again. We saw this last time. We did a problem last time. Revenues. And here they're showing it net, right? Net of returns, allowances, and discounts. We talked about that last time. Sometimes you'll see it with the gross revenue, and then they'll show you these individual amounts. But here what they did is they kind of combined things. Cost of goods sold, gross profit. Administrative expenses, operating income. And remember, I told you last time, this is probably the most important number on the income statement. This is the number that tells you what did the company, how much profit did the company make doing the thing they went into business to do. And this is Best Buy. What is Best Buy in business to do? They buy electronic stuff, right? And then they sell that stuff. This is how much profit they made doing that. Now, sometimes they have other income and other expenses that have nothing to do with what took place up here. Miscellaneous types of things. Gain on sale of investment. Well, you know, they're not in the investment business, but okay, so they made $3 investing in something. They have investment income. They had some extra cash. They were able to go out and invest it. They have some interest, some dividend income. And interest expense. Remember, interest expense doesn't go up here. Interest expense goes down here on the bottom, right? Interest expense is a non-operating expense. And why? Because not all companies have interest expense. Some companies borrow money and some companies don't. So how do you compare a company that borrows money to one that doesn't? You look at this number, this operating income number. That takes you to income before taxes, subtract the tax expense, and that's the net income, right? So is net income the most important number on the income statement? Not really. I mean, it's not that it's unimportant, right? But the most important number, the gauge of how successful a company is how much profit did they make from their main business, right? And that's what this operating income shows you. And we did that for homework last time. Okay. So here's the stuff that we're going to concentrate on today. Inventory cost methods. Determine cost of goods sold and ending inventory using these different methods. What are the different methods, right? There's 4 of them. Specific identification, first in, first out, or Fifo, last in, first out, or Lifo, and weighted average cost. I want to see. Okay. So let's go back and look at that homework again. Right, that was chapter 6. Let's see how they want us to give the answer. See how they want us to give the answer? Putting a number in a box. Putting a number in a box, right? Putting a number in a box. So they don't give you a space to show how you got your answer. So that's what we're going to concentrate on, because anybody can put a number in a box and just take a guess whether it's right or it's wrong, right? But let's first talk about this, this topic. Okay. So the example they give you, you've got this company called Mario's Game Shop, and they sell video game controllers. Now, at the beginning of the year, they had in inventory 100 of these things. They paid $7 a piece for them, so the total was $700. During the year, they bought more. During the year, in April, they bought 300 more. They paid $9 a piece for them. 300 times 9, 2,700. In October, they bought 600 more. This time they paid $11 a piece for them. Notice how the prices are going up. That cost them $6,600. Right, so you get the idea. They started out with 100. They bought 300 more in April. They bought 600 more in October. And this is what they paid. So for the entire year, what did they have available for sale? They had 1,000 of these controllers, and they paid $10,000 for them. Are we together so far? Do you get the idea? No? Can't hear me? All right, now, during the year, and again, this isn't terribly realistic, right? They made 2 sales during the year. In July, they sold 300. In December, they sold 500. They sold 800 of these things. Well, if they had 1,000 and they sold 800, how many do they have left? 200. 200. Right? 200. The challenge for us is, how do we calculate ending inventory? What dollar amount are we going to assign to these 200 units? And once we do that, it's very easy to figure out what cost of goods sold is, because all we have to do is to take this number that we got for inventory and subtract it from this total available number, and that'll give us cost of goods sold. Right? So again, of the 200 controllers that are left in inventory, which are they? Can I tell you exactly which ones they are? Specific identification? Should I take an average? Right? Let's see, 10,000 divided by 1,000 is 10. I could say, well, the average price I paid was $10 a unit. Or I could say, do I have the oldest units or the newest ones? Those are the 4 methods. That's how it works. Let's save specific identification for last. All right? Let's talk about the average method first. Right? Because we kind of talked about that just now. So to figure out the ending inventory using, it's really called the weighted average cost. The weighted average cost. It's a 2-step process. The first step is to figure out what's the average cost of a unit. the average cost of a unit is $10, right? If I paid $10,000 to buy 1,000 of these things, the average price I paid was $10. If I have 200 of them left, 200 times 10 is 2,000. Ending inventory is 2,000. Well, what's cost of goods sold? They're showing you here 800 times 10. Yeah, that's true, but I want you to kind of forget that. Right? What I want you to do is to take this 2,000 and subtract it from this 10,000. 10,000 minus 2,000 is 8,000, right? And that goes back to what I showed you earlier is this thing. Right? So this is your guide, if you want to call it that, to how you calculate cost of goods sold. It's total available minus ending inventory equals cost of goods sold, right? So just keep that in mind. So for average cost, 2 steps. First step, figure out what the average cost of one is. The average cost of one was $10. Multiply that by how many units you have, 200, right? That's 2,000. Subtract 2,000 from 10, and you get your cost of goods sold of 8. In theory, this is right, but I just want to show you the simpler way to do this. See, you're only being asked to put numbers in a box, so let's just do it the easier way. All right, let's talk about first in, first out. First in, first out. Now, under first in, first out, it means you're selling the oldest units first. So what you have left in inventory is the newest. Now, what are they showing here? They're showing you here, right? If you go back to the original illustration, you started with 100, you added 300, you added 600, right? You sold 300, you sold 500, you sold a total of 800, you have 200 left. Under first in, first out, you're making an assumption that you sold the oldest ones first, these. So what do you have left in inventory? These. Now, how many units do you have left? 200. Which are the newest 200 units? Which layer did they come from, right? We call these things layers. 1 layer, 2 layer, 3 layers. Which is the newest layer? This one. So the 200 units I have left come from this $11 layer. Well, what's 200 times 11? It's 2,200. So ending inventory is 2,200. What's cost of goods sold? It's 10,000 minus 2,200. Now let's look at what they show you. And it's not what they're showing you is wrong. It's just a little complicated. See, they're showing you on a unit basis what was sold. So what I'm telling you is concentrate on calculating this number, this 2,200, and then what's cost of goods sold. It's 10,000 minus 2,200 is 7,800. You see, here they're showing you, look, they're saying that if you had 1,000 units available to sell and you had 200 units left, which ones did you sell? You sold the oldest ones. You sold these 100. You sold these 300. Of the 600, you sold these 400. That adds up to 7,800. That's fine. You could do that. But there's a quicker way. Figure out this 2,200 and then subtract it from 10,000. You'll get the 7,800. That's first in, first out. Last in, first out. Last in, first out says, I sold the new stuff first. I always have the old stuff. The oldest stuff. Now, again, go back to your beginning point, right? And to me, this little chart is the most important thing in the problem. What last in, first out says that if I look at this diagram, which products was sold first? These, the 600. Now, if I sold 800, that means 200 was sold from here. Now, I just want to calculate the ending inventory. So the ending inventory consists of 200 units. Which are the oldest 200 units? Well, this 100 is the oldest, 100 times 7. And then, which are the next oldest? These. Well, how many did I sell from that layer? Or how many do I have left from that layer? 100. Right? I have 200 units left. If this is 100, then this has to be 100. I know it says 300, right? But we have 100 of those left. The other 200 was sold. So 100 times 7 and 100 times 9. Add those two together, and that's the ending inventory. I think that should be 1,600. Right? So I have this 100 times 7, and then I have 100 of these that I paid 9 for, right? 7 and 9 is 1,600. Now, I can calculate cost of goods sold like this, but why do I want to do that extra work? Let me just take this 10,000 and subtract the 1,600, and that'll give me the cost of goods sold of 8,400. All right, now let's talk about specific identification. Specific identification, you know exactly which ones you have left. Exactly which ones. Well, they don't even show you an example here. Let's see, what do they say? Okay, now they say here, suppose that Mario's Game Shop was able to track the 800 units sold. Suppose the actual units sold include 100 from the beginning inventory, 200 from the April 25th purchase, 500 from the October 19th purchase. The cost of those units would be reported as cost of goods sold. The cost of the 200 units remaining consists of 100 from April 25th and 100 from October 19th. That would be reported as the ending inventory, right? So if you go back up to the chart, right, let me just write this down because this can get confusing. Right? They're saying that actual units sold from the beginning inventory 100, from the April 25th purchase 200, and from the October 19th purchase 500. Right? So what's left? The 100 units remaining consist of 100 from April 25th and 100 from October 19th. Well, 100 from April 25th, 100 times 9 is 900. 100 from here is 1,100. That should give you what, 2,000? Okay, they don't even tell you what the numbers are. So now let's do the homework problem. Let's see if we can get the homework up. Let me see, let me find it first. I should have done this before I met with you. Are we okay? Can someone answer me and let me know you're alive? No? Am I talking to myself or is somebody there?
Hello?
Okay.
Yeah.
Hello?
Thank you.
Yeah, you're good.
It gets very lonely sitting here sometimes when no one makes a sound other than me. And it makes me feel like I'm nuts, like I'm talking to myself, you know? Okay. So we're going to do now, this is problem 1, right? And we kind of saw this earlier. Sarah's Purse Boutique has the following transactions related to its top-selling Gucci purse for the month of October. Right, so this is what took place during the month of October. Calculate the ending inventory of cost of goods sold using the different methods. Let's use these 3 methods first. We'll do the specific identification last. So the first thing I like to do is to construct a table, right? What I like to do is similar to what the textbook showed you in that Mario's game store example. Where we're going to start with the beginning inventory, and then we're going to add the various purchases, right? So let me see if I can get Excel. See, you know, again, in the book, they just say, put the number in the box, right? But you have to know what you're doing, right? So this is problem 6-1A, right? Which is on page, if you look in the textbook, it's on page 331. And let's see. Let's have a column for date. Let's have a column for transaction, let's call it. Units. Let's call it number of units. Unit cost and total cost. Okay, make it look pretty. Let me just see if anyone else has joined. Okay. Okay, so let's go back to the example now. We have October 1st, beginning inventory. And we had 6 units that we paid $900 a piece for. That's a total of $5,400. Right? And then on October 10th, we made a purchase. I'm not interested in the sales yet, right? So I made a purchase. I purchased 5 of these things, and I paid $910 a piece, right? So if I get my calculator out, 500 times 910, 5, not 500. 5 times 910 is 45.50, right? And then I bought some more. October 20th, I bought some more. I bought 4, and this time I paid $920. 4 times 920 is 3680. And then October 30th, I bought some more. I bought 7, and this time I paid 930. 7 times 930 is 6510. Total available for sale. Add these up. 6 and 5 is 11, and 4 is 15, and 7 is 22. I don't know, maybe I should not do that, right? Maybe I should 22, right? And over here, 20,140. I don't have to add this column up. Okay, so, right, I started out the year with 6 units. I bought 5 more, I bought 4 more, I bought 7 more. I had a total of 22 units. At some point during the year, there were 22 units in the store available to sell. Right? I paid different prices for each one. So what did those 22 units cost me? They cost me $20,140. Okay. Now I'm going to go out of order. They always show you average cost last. I like to do average cost first, right? Because it's kind of an easy one to see. But this was part D. They call it weighted average cost. Okay. So for weighted average cost, we had 2 steps. The first step, what's the average cost per unit? And to do that, you're going to take the total available, 20,140, and divide it by the units available, 22. Right? So that comes out to 20,140 divided by 22. Okay, now that I say about rounding, got to pay attention to rounding in these things. Okay, they don't say anything about rounding, but I think when you do yours, they're going to say round to 3 decimal places, right? That's what I'm going to do. 915.455. Step 2 is to take the units in ending inventory and multiply it by the average cost per unit. Right? Now, how many units are left in inventory? Oh, I didn't do that. I should have done that here first before I did that. Let me take the units sold. How many units were sold? On October 4th, I sold 4. On October 13th, I sold 3. And on October 28th, I sold 7. So how many did I sell altogether? 4 plus 3 is 7, and 7 is 14. So if I had 22 and I sold 14, how many do I have left? I have 8. Right? This is units ending inventory. this 8. So how do I get the dollar amount of ending inventory? I take this 915.455 and I multiply it by 8. Right? And what will that give me? It'll give me 7323.64. Let's round it to 7324. Because you can't have a 0.64 unit of inventory, right? You can only have full units of inventory. So let's say we have the dollar amount is 7,324. Okay. So that's how we calculate ending inventory, right? I'll put EI next to that. Now, how do I calculate cost of goods sold? Right? Cost of goods sold is total available for sale minus or less ending inventory. So what's the total available for sale? It's 20,140. What's the ending inventory? 7324. So what's cost of goods sold? It's 12,816. Right? So this is cost of goods sold. 12,816. All right, so just to recap, you make your chart, start with the beginning inventory, add the purchases, get this total available number. This is a very important number. Don't underestimate it. Subtract the units sold. In this case, it was 14. So how many do we have left? 8. What's the dollar amount of the 8 units we have left? Under average cost, I have to first figure out the average cost of 1 unit, which came out to this 915,455. If I multiply that by 8 units, I get this 7324, right? And then to get cost of goods sold, I take the total available number and subtract the ending inventory, right? COGS, right? Cost of goods sold. So those are your 2 answers, right? You would put this in one box, right? And then you would put this number in the other box. Okay. So that was part D. I did part D first, right? Now let's do first in, first out. First in, first out was part 2. First in, first out, right? And I'm just going to make a note here. Ending inventory equals newest units. Ending inventory equals the newest units. Because you under first in, first out, you sold the old ones. So what do you have left on your shelves? The newest ones, right? The nice, shiny, most up-to-date, newest ones. Let's go back to our chart. How many units do we have? We have 8, right? We have 8, right? We figured we have 8. Well, which are the newest 8? Look at the dates. Which is the most recent date? October 30th. 7. So I have 7 from October 30th. Which are the next newest? Here. I have 1. I have these 7 and then 1 of these. Okay. So let's say October 30th. Okay. That was the most, let's call it newest units purchased. 7 times 930, right? What was that? Go back to the chart. 7 times 930 is 6510. October 20th was the next newest, right? If that's such a word. Right? Now I need 8 altogether. So if 7 came from October 30th, that means 1 came from October 20th. And on October 20th, I paid $920 a unit. So those 8 units cost me $7,430. Right? So this is ending inventory. Under first in, first out. What about cost of goods sold? Cost of goods sold is what? Just calculate it the same way. It's the total available for sale less ending inventory. The total available for sale was how much? It was $20,140, right? Go back to your chart. $20,140 minus ending inventory, which was here, $74.30. So $20,140 minus $74.30 is $12,710, right? That's cost of goods sold. Right, here's your ending inventory number. Here's your cost of goods sold number, right? So when you're doing the problem, you have to put numbers in boxes. This number goes in the ending inventory box. This one goes into the cost of goods sold box, right? But again, one of the weaknesses of using the computer system is it doesn't ask you to do this. It just wants you to put a number in a box. So if you don't have a method to solve the problem, how are you going to come up with those numbers? All right, the next one, let's say, is last in, first out. Number 3, LIFO, last in, first out. Now remember, under first in, first out, ending inventory was the newest. Under last in, first out, it's going to be the oldest units. Now, the oldest units is always the beginning inventory, right? It's always the beginning inventory. And the beginning inventory consisted of 6 units times 900 was 5,400. Okay. What's the next oldest? The next oldest would be from October 10th. Now, I need 8. So if 6 came from October 1, how many are going to come from October 10? 2, right? 6 and 2 is 8. On October 10th, I paid $910. So what's 2 times $910? It's $1820. So those 8 units cost me $7,220, right? $7,220. That's the ending inventory. Let's put EI next to that. So when you're filling out the boxes, that goes in the box. Cost of goods sold. Again, what's cost of goods sold? It's the total available for sale less the ending inventory. The total available for sale again is 20,140. In this case, the ending inventory is 7220. What does that come out to? 12,920. That's your cost of goods sold, right? Cost of goods sold. So do you have to calculate cost of goods sold by counting how many units you sold from each layer? No, you don't have to do that. All you have to do is subtract the ending inventory from the total available for sale, right? They're not asking you to do anything more than that. Okay. All right, so now we're going to look at specific identification. Let's go back to the chart. Okay. Specific identification. Calculate ending inventory and cost of goods sold using specific identification number. The October 4th sale consists of purchases from the beginning inventory. Now, the October 4th sale, we sold 4 units. So 6 minus 4 equals 2. That means we have 2 units left from beginning inventory. Right? I'll go say that again. The beginning inventory consisted of 6 units. The October 4th sale, we sold 4 of those units. So how many of those do we have left? We have 2 units left. Right? We have 2 of those units left. The October 13th sale consists of 1 purse from beginning inventory. So let's see. We have 1 left now, right? One purse from beginning inventory and two purses from the October 10th purchase. 5 minus 2 equals 3. We have 3 of these left. Okay, the October 28th sale consists of 3 purses from the October 10th purchase. Minus 3 equals 0. So all those purses were sold. 3 purses from October 10th and 4 from October 20th. 4 minus 4 equals 0. So how many purses do we have left? We have 8 purses left, right? We have 8 purses left. Which 8 do we have? We have 1 of these and 7 of these. So if we just do a quick calculation out here, 1 times 900 is 900, right? And 7 times 930 is 6510. What do we have left? Ending inventory is 7410, right? Ending inventory is 7410. Right? So it's a little tricky. You have to go back and you have to say, okay, of each sales transaction, how did it affect these layers? And the way it worked out, we sold all of these, we sold all of these, we wind up with 1 of these and 7 of these. That's where the 8 comes from. And then let me put this here, ending inventory, right, is 7410. What's cost of goods sold? It's 20,140 minus 7410. It's 12,730, right? 12,730 is the cost of goods sold. All right, so now you can do that homework problem, right? And I don't really care what order you go in. I did it in the order that I think is easiest to see it, right? But you can go in any order you want. And maybe what you want to do is to print the problem out and work on it on a piece of scrap paper like this. And I'll put this up so you can have it to look at. All right, so let's see. We have a little time left. Got people that come late. I don't understand it. I'm assuming everybody's home. Okay. All right. Let's see if maybe we could work on one together. Let's pick one. In real life, nobody uses that specific identification. The only time you would use that is if you had a very small inventory of unique items. Let's say you had an antique shop and you only had at any one given time, you had 10 or 15 or 20 items in inventory. You might use it there, right? But if you're in any type of mass-produced environment, think of a company like Johnson & Johnson that makes Tylenol, right? And Johnson & Johnson is making thousands of bottles of Tylenol. You can't go and count each bottle to see which ones you have left and which ones you sold, right? It would take you forever to do that, right? So that's where the Lifo, Fifo average cost comes in these environments where the products are mass produced. All right, let's see. We have another easy one we could do. Let's see. Okay, now if we look on page 324, brief exercise 6-5. Let's take a look at this one. Calculate ending inventory and cost of goods sold using FIFO. Now, if you look at these three, 6.5, 6.6, and 6.7, right? We're taking the same information, and in 6.5, we're using first in, first out. In 6.6, we're using last in, first out. In 6.7, we're using average cost, right? For the same problem, for the same set of numbers. And if we really wanted to, we could do 6.8 is specific identification, right? So let's see if we can do this. During the year, Wright Company sells 470 remote control airplanes for $110 each. The company has the following inventory purchase transactions for the year. So they started out with 60. They paid 82 a piece, $49.20, right? And then they made two purchases during the year, one in May, one in November. This is what they bought, how much, right? So what's the total available for sale? 510 at a total cost of $44,170. how many do they have left? If they had 510 and they sold 470, how many do they have left? 510 minus 470 is 40. So they've got 40 of these remote control airplanes left sitting in their store. What dollar amount would we place on those? Under first in, first out, under last in, first out, under average cost. Why don't you take a few minutes and try to come up with that, right? And if you're able to do first in, first out, then go on to last in, first out. If you're able to that, do average cost. If you're able to do that, then go on to specific identification, right? So I'm going to leave this up here. I'm going to pause. Okay, so we're recording again. And let's quickly review the problem. But let me talk you through it first, and then we'll work numbers out. So this company sold 470 of these products they have. Well, how many did they have? They had 510. So if they had 510 and they sold 470, that means right now they have what? 40 remaining in inventory. Well, which 40 do they have? Do they have 40 from here, 40 from here, 40 from here, some combination? Which ones do they have? Well, we have assumptions to make. In other words, if we're using the Fifo method, which 40 do we have? We have the newest 40. Those newest 40, right, of all that you see here, January 1, May 5th, November 3rd, which is the most recent date? November 3rd. All 40 come out of this 200. Right? So 40 times 90 is 3,600. Ending inventory would be 3,600. What would cost of goods sold be? It's the total available minus the ending inventory. 44,170 minus 3,600, whatever that comes out to be. Right, now what about Lifo? Under Lifo, the units that you have are the oldest. Fifo newest, Lifo oldest. Which are the oldest of the three dates? Which is the oldest? January 1. How many units do I have? 40. So I have 40 out of this 80, out of this 60, right? 40 times 82 is what? 3,280. What's cost of goods sold? Total available minus ending inventory. BE67. Average cost. What's the average cost of one unit? 44,170 divided by 510 comes out to $86.61 rounded. That's one unit. How many units do I have left? 40. 40 times 86.61 comes out to 34.64 rounded. What's cost of goods sold? It's the total available minus the ending inventory. Specific identification. Let's hold off on that till we get to it. All right, so let's see, where's my Excel? BE 6-5, right? PE 6-5. And this is first in, first out. On the first in, first out, the 40 units come from the 40 times 90 equals 3,600. That's the ending inventory. So all 40 came from November 3rd. Right? That's ending inventory. What's cost of goods sold? It was that total available, right? Total available for sale, which was 44,170 less the ending inventory, which is 3,600. All right, so that comes out to 40,570. Right, that's your cost of goods sold. 6-6 was Lifo. Now, under Lifo, we have the oldest units. Which are the oldest? The oldest are always the one at the beginning. January 1, 40 times 82. So 40 times 82 is 3,280. That's the ending inventory. What's the cost of goods sold? It's the total available for sale, 44,170, less the ending inventory, which was 3,280. Right? That'll give you 40,890. Cost of goods sold. BE 6-7. Weighted average cost. Remember, this was a two-step process. The first step was to figure out the average cost of a unit. And to do that, you had to take the total available, right? The total available, 44,170 divided by 510. And that came out to $86.61 per unit. That's rounded. And step two would be to take that $86.61 and multiply it by the number of units you have in ending inventory, which came out to 3464.4, but rounded, let's call it 3464. That's ending inventory. What's cost of goods sold? Same as before. Total available for sale, 44,170, less ending inventory, which is 3464. $40,706. That's the cost of goods sold. Okay, specific identification. Number 8. Let's read what it says. Calculate ending inventory and cost of goods sold, assuming the company uses specific identification. Actual sales by the company include its entire beginning inventory. So how much beginning inventory do they have left? None. They sold it all. Okay. What else? 230 units from the May 5th purchase. May 5th purchase. They had 250, they sold 230. What do they have left? 20. 20 times 85. Should we write that down? 20 times 85. 1,700. What else? They sold 180 from the November 3rd purchase. They had 200, they sold 180. What do they have left? 20. 20 times 90. What's 1,700 plus 1,800? This was from the May, right? And this was from November, right? So what's 1,800 plus 1,700? It's 3,500. Ending inventory is 3,500. What's cost of goods sold? It's the total available for sale less the ending inventory, which we just calculated to be 3,500. Okay, so there you have it. That's inventory and cost of goods sold. We did the homework problem first, right? And now we just did these brief exercises, which was simpler because all the inventory was contained in one layer, right? In the other problem that we did for homework, we had to go into 2 layers to calculate the inventory, right? Here, 7 in 1, 6 in 2. We had to go into multiple layers to calculate the inventory. And once you know inventory, cost of goods sold is a snap. Just take the total available for sale and subtract the ending inventory. You don't need to get any more involved in that. So with that, I'm going to leave you. Remember, this homework is due on Friday, day after tomorrow. After chapter 6 is an exam. Let's see. Something happened. Exam. Exam 3. Okay, November 25th. So that's a week from today, right? That's the day before Thanksgiving. So make sure that you get it done on time. You know, don't let it go, because, you know, the closer you get to the holiday, the more frantic things get. So, you know, make sure you get it done on time. Remember, you also have the extra credit. And the problem comes from chapter 5 this time. All right, so with that, I guess I'm going to leave you. Does anybody have any questions? Okay. So with that, I'm going to leave you. Have a nice day, nice week, and I'll see you next Wednesday. We'll start chapter 7.
Have a good
Thank
one,
you. Have a good day.
Professor. Have a good one.
See you later.